Ladies and gentlemen of the crypto space, we're live on a Monday, March 27th at 11:37 a.m. We see markets as they've been for quite some time, boring, complacent. It's not like there's exuberance, there's not outperformance. This is a negative sum game. And what's most interesting is the decade-long picture, more than a decade at this point, and the negative sum game that has been occurring since 2008 with global currency units basically contracting. We've spent the last 2 years digesting what is money, what is most money, and most money is credit. It's borrowed money, as there's really no difference between borrowed money and actual money. You could spend borrowed money just as you would actual money, a paper bill. You don't need a paper bill to make a payment. And it gets even more in depth, deep, complicated, sophisticated when you talk about how cross-border payments are made, how capital flows between banks. They don't settle in dollars. In the U.S., a good part of interbank settlements is reserves, which is basically how QE got off the ground and how that loosens the gears of liquidity through banks. And as the banks are able to settle between one another more freely, they're in a better capital situation, which, as a knock-on effect, plays into their capacity to lend, to create credit, to create money. When you create money, that money's going to be spent. When that money's spent, it invokes economic activity. When there's economic activity, there's profits. When there's profits, the cycle continues. People spend money. So obviously, most folks here are interested in crypto markets, and sorry to say, that is probably one of the first places where people are going to sell things when they need money. The argument from a multi-cycle perspective, intra-cycle, because what we really need to understand is the currency cycle, which the last time we had a peak in available currency was in 2008, and we've never recovered. So what we've had since 2008, these cycles, as we call them in the crypto markets, is reallocation of capital in a global negative sum game. Plenty of reason for capital to reallocate, plenty of reason for opportunity to be seen in varying markets, and someone says, I no longer like that investment, I'm interested in another investment. Plenty of reason to understand that there's a tremendous amount of money in the system, even considering the amount of deflation that has occurred. But ultimately, it's all relative, meaning coming off of deflation is a decrease in currency units. So there's fear, there's uncomfortability. So we've been in that state since 2008. So these interim periods of currency availability, excess currency supply, and the reallocation of capital is forcing people to make better choices where they think their money is going to be better productive, more allocated to something that has a narrative that will carry into the future. So in that context, there's a great reason to suspect capital will remain in the crypto markets. And let's go over to the chart. We could highlight the 15-year perspective that I keep in mind when I say this kind of content. There's overall $132.75 billion worth of capital that is available in the crypto markets. The market cap, and the total TVL as a metric that people look at. It's an actual metric, but I don't think That value is what's meaningful, because the maximum amount of value that every single asset in DeFi markets can be sold for is $132.75 billion. That's it. Everything else is fluff. It's a relative inflated value. So it's misleading in that regard. But look where we've come since end of 2019. All of this, these currency units, these dollar derivatives, synthetic currency units in part, but a good part of them are actually derived from actual currency units. At least USDC is. BUSD was until it has been canceled. Tether is a euro dollar, so it derives its value from collateral. They are loans against collateral. So this has been an inflow since late 2019. So what does that mean relative to the deflation since 2008? This is a reallocation of capital from other systems to this system. Now bear in mind this number is basically zero. So this is the earliest of earliest. So you know when folks say we're early, that needs to be considerate of time frame. We can be saying we're early for a decade before a meaningful amount of capital is allocated, and we won't know that a meaningful amount of capital will be allocated until the aggregate opinion of investors and governments create conditions where more people see the benefit, the significance of these types of technologies. And in good part, I expect increasing resistance in the short term. These systems that we hold so dear are encroaching on the territory of traditional financial infrastructure. Look how long it took Tesla to catch momentum to the point where even Toyota says what they built was brilliant. It's been a long, resistive road, and they almost experience failure many times. So that's the same thing you're going to expect to see, or really should expect to see, from the vast majority of the systems that you play with, especially on the L2s. You know, the narrative in the short term is survival and is still Bitcoin and starting to be Ethereum. The L2s are, it's hard to even put into the context that we're describing how microscopic they are. It's kind of like just a startup company, and there's no global systemic significance, no global systemic excitement. The numbers are basically zero. And it's very much a marginal zero-sum, negative-sum game, even if you see capital inflow into an L2, because why would someone keep the capital there if we're in a global deflationary currency state? The odds are it's an opportunistic allocation of capital to be extracted to a safer location. The safer location relatively in the context of crypto would be Ethereum mainnet for that degree of finality, the scale and scope of the node infrastructure as compared to the small security footprint of each L2 respectively. So then you have to make the consideration of capital outflows out of these markets, which we see, and we see like Whalebot, and you know how much capital has been removed from USDC or sold from Tether. I mean, Tether's primarily going to be mostly minting because that's a euro dollar. You have collateral and you're putting it to work. If you're going to put that collateral to work here, what's the point of retrieving the collateral? The odds are the collateral is depreciated, and it's not necessarily favorable to retrieve the collateral from the Tether deposit. So these, BTFP is quite interesting because they're offering a loan at face value. We don't necessarily know how much of a loan is issued against collateral posted to a Tether account. The odds are it's not face value. The odds are it's not necessarily market value, speculatively, because that is something I postulate as a common occurrence with regard to the Eurodollar system. There's advantages, there's benefits to both parties with regard to the posting of collateral and borrowing currency units against that collateral. Obviously, Tether is receiving a tremendous amount of financing direct from the debt issuer. So, if their attestations are to be digested, the vast majority of the debt on the books is by the U.S. federal government. So the U.S. federal government's paying them a large amount of money. So there's and how do you incentivize someone to deposit capital with them to give up those coupon payments by giving maybe a little bit more than market value? So there's incentives on both ends, and I don't think it's just market value that the loan is issued against. And I think that happens to a greater degree in the real world as well. Um, Overall, this is highlighting or gives us a glimpse of the pressures in the system, and that helps us understand current market conditions and really where things are heading. Most of my sentiment hasn't changed. This is a period of survival and really digesting how we manage our portfolio, our capital structure in a way that's sustainable. The most important thing with regard to how to engage with markets sustainably is our mental state, our degree of calm. You could use the word conviction, but it's also foresight, and it's very easy to have a long-term time horizon with productive assets. And, that those productive assets probably should be looking also at some equities as the price points of all assets, even in the crypto space, have gone down. Interest rates go up if there's effective cash flow. And that's obviously what happens, the inverse proportionality with returns on U.S. sovereign debt. Interest rates have gone up significantly. And this happens with stocks as well. This is an interesting stock that a friend put me onto, and there's a whole host of considerations when you're dealing with an actual real world company that has human resources, that has liabilities, or risks associated with their enterprise, with what they do, with geopolitical risks and actual physical risk for, in this instance, ships. Can you imagine in this geopolitical climate the risk to international transport, security of actual physical vessels traveling the seas, the energy requirement to fuel the ship, so on and so forth, all that complexity? So this was a much higher priced asset, and as it was higher priced, I think it was like 30-40% in dividends, but the dividends are sitting at 77.22% for a company that produces cash flow from international shipping. Now, the prerequisite, obviously, as I highlight more and more and more, is you have to inspect the balance sheet to understand the relative health of the enterprise. You look at the history, you do your due diligence, so on and so forth. I mention this because this is an asset I'm down 50% on, but the dividend, the income that it produces, is unchanged because the dividend has gone up as the asset price has gone down. And this happens to be a rare instance of an equity that I found interesting. This is an international shipping company that deals very technologically, whereas the vast majority of all traditional enterprise is very entrenched, boring, backward looking. They're really trying to just maintain their existing infrastructure, and they're not forward looking. So this caught my eye maybe a year ago when it was in the 50s and 60s. Not that it's incredibly productive in the context of a risk adjusted perspective, but it's interesting nonetheless how it fits into an overall productive portfolio. So, risks abound. I look forward to seeing what's on your guys' minds. Let's take a look at the markets real quick before I get to comments. Bond volatility has come down a little bit, but this thing is basically still screaming red hot. I put up the DXY against it. Not necessarily something I could make a reasonable inspection about right now, but I was just looking for some patterns. There was the correlation between bottom in July and the appreciation of the dollar and bond volatility just basically creeping up the entire time. But that correlation doesn't necessarily hold, especially coming off of '08. And notice the time frames I'm using. I'm on the 6-month time frame. So zoom out, and we're in one heck of a situation with global financials. They have big decisions to make, and the question is really how much deflation can the system withstand? And I just over the last couple of months, the way Jeff Snyder has talked has really hit home more and more with me, and just invalidating the incorrect, not necessarily use of the word inflation, but attention of uh, where the word is used in political rhetoric, regulator rhetoric, and just our conversations. And the focus has been on consumer price inflation. And I'm not so interested in the result. I'm so much more interested in the cause. The cause of these pressures in the system is what tells us the conditions we're in that gives us insight into where the system as a whole is heading. And he just nails it. He's the only person that talks about how much deflation has occurred in global currency, and it really hits home when you start to think about the knock-on effects of a deflationary global currency uh, uh, directionality and how it has an impact on the decision-making process, the flow of capital between countries, the flow of capital within a country between different sectors, the risk and restraint associated with the deployment of capital. If you don't necessarily have access to capital, you're probably going to be very restrained in deploying that capital. And that's the exact same thing for us. You know, when we talk about these things, especially the streams of late, we talk about them very much in the context of countries, the flow of capital between countries, and just the flow of capital between businesses within a country. But you can see that also with us. If you have less free money, you're probably going to be thinking twice before spending it. If interest rates are higher, you're probably going to be thinking twice about spending money on a credit card or taking out a mortgage or taking out a personal loan. It slows the shit out of everything. And that is the intention of what the Fed wanted with regard to raising interest rates. And then we could speculate that it wasn't really the slowing of the economy that they wanted because they have access to all this information. They know the state of global currency availability. They understand the shit that Jeff talks about and the stuff that we've been talking about. And they understand that the global economy has already been contracting significantly ever since 2008. They have all this data. So that's why we could easily jump to the train of thought that there's ulterior motives, not motives, but an ulterior strategy, ulterior desires that they're trying to achieve. And obviously, we know that from a geopolitical perspective. When you raise interest rates, it has a more profound effect internationally as compared to domestically. And domestically, it's all politics. And that's exactly why the politicians talked ever so much about consumer price inflation. The problem is, do you constrain and encourage the contraction of domestic U.S. liquidity to such a degree that you could catch up with supply chains and the availability of goods and services. And that becomes a political hot potato also, because there's a point where people start getting pissed off and the consumer price inflation doesn't come down because the supply chains just can't keep up. There's too many people. There's too many fucking credit cards. There's too many people in this country that are expecting to be able to maintain their way of life, their status quo, their meal on a Friday, going out with the family on a Saturday, their vacations, and you'll get and well, political unrest as a result of civil unease, and there's political ramifications to trying to contract the economy too much. And we could see it. We could see it with the unrest. People are uncomfortable. They're frustrated because people are short on dollars. So, complicated choices. How much power does the Fed have? Complicated choices that they have to make with regard to what little control they have. Do they have control? Is it not the general public that ultimately has the control? If the general public really shows signs of civil unrest, they're not going to take it anymore. You know, then you can't. How are you going to keep restraining the expansion of capital in the U.S.? You need to let companies grow. But we're going to get to the way before that. We're going to have complexities with regard to just financial stability. Probably one of the next shoes to drop is commercial real estate because there's no recovery from that. Now, we could have other events in the meantime. Are banks lending? Why the fuck would any of the banks be lending? Right now, they're freaking out about their balance sheet health and what just played out with few banks. Government wants to think that it's contained, and it could be, especially with interest rates coming down marginally. But how does that affect the behavior of people? The behavior of people is still fear. Anyone, especially with large amounts of deposits in these institutions, probably going to play it safe and migrate capital. So the structure of regional banking, their balance sheets is changing dramatically. The flow of capital is becoming more concentrated. There is very well the likelihood that there could be another systemic event, because we just had a systemic event. Intervention of a systemic event does not imply a systemic event did not occur. It did occur. We had bank failures in the United States and Switzerland, and probably Germany's next. Um, but it's commercial real estate. And that has to do with demographics, social norms, employee expectations. There is absolutely no way that in 2019 the amount of commercial real estate office buildings that was occupied, it's just impossible for those same offices to be rented. So deflation. The amount of office space required will deflate. So the question there with regard to systemic risk is, can it be repurposed enough to such a degree that a good portion of the $1.5 trillion worth of commercial real estate debt doesn't blow up, insolvent, can't pay the bills. If you don't have someone renting your fucking office space in downtown San Francisco, you're not going to be able to pay the bill. That's just the bottom line. That's how the equation works. So, let's talk about our individual selves. I know I do my big macro, big picture rants when I start the stream, but what can we do? What do we do in the meantime? How do we navigate a little bit? Why am I so relatively cool and calm? How does this guy do it? 29 people in the stream, 7 likes. I appreciate all of you. Click that thumbs up button. Raul's in the house. Dan, a pleasure. Gazika live on Live on Turmoil. To say the least, I find it interesting. As I've said before, I find my calm, my comfort understanding these things. And, you know, I expect depreciation. I also expect continued productivity. Like when I showed you guys the shipping company a couple of moments ago, they could go away. The company might not work. Maybe the executives, they just don't want to run the company anymore because of geopolitical risks and uncertainties and all the shit that goes into a real world business. So, in that regard, I find greater comfort with some of the assets that I own and some of the enterprise that I own, the digital enterprise. They can't go bankrupt. They will be here in some state, some form or another. And if we go over to the liquidity, because it's stable coins that matter, it's not TVL. Oh, no, I don't want to go to chains. I want to go to overview of DeFi. And we could see where the TVL in this instance, but we could make a nice observation of the TVL for stuff like Curve Finance, sitting at $4.64 billion, almost $1 billion more than Uniswap, predominantly stablecoins, currency units, dollar proxies, or other foreign currency derivatives. And that's meaningful to me. Um, there's plenty of risks and complexities associated with the assets that are contributing to the volume. Isn't there? Yeah, volume. There's a DeFi Llama is such a titan. Look at the volume on Curve. $154 million a day. Now, if you put that into context of the traditional enterprise, holy fuck. I would love a company, a stock that had $154 million a day in activity, buying and selling whatever their product is. In this instance, the product here is transactions. And inspect the balance sheets. If you literally just look at assets from a traditional value investor methodology standpoint, this is why I'm so comfortable. Can it depreciate? Sure. Is it probably going to depreciate? Sure. Is it going to survive as a piece of software? Yes. Can it be invalidated? Can the narrative be invalidated? Yes. Can the narrative of an enterprise and a stock be invalidated? Most certainly. What are the relative degrees of risk? In my mind, there is so much less risk with this capital deployment as compared to many enterprises that I own and inspect with regard to stocks. What kind of disruption to cash flow can occur with a traditional enterprise as compared to these types of enterprises? Is this capital needed? This capital wouldn't be deployed to crypto markets in this global context of what is occurring in these systems if it was truly needed. This is marginal capital. This is microscopic, non-existent capital. This is fraction of a percent of nothingness. So there's so much reason for this capital to just remain churning and churning in a zero sum, marginally negative sum over time game. So I don't want to be an actor in this space that is chasing outperformance or chasing capital gains in a negative sum environment, because that sets the tone for what actors are going to do. An actor, a person, an investor, what they're going to do. And there's the predator analogy, the biological system. The predator, now you have to understand how much capital they're throwing around and the vested interest in the protocol, and you're facing a very powerful adversary. In most instances, many very powerful adversaries that move markets, that own markets. I mean, if I had larger amounts of capital, I would be owning LPs. Liquidity providing on Uniswap is not profitable for small actors. But if you could own 50, 60, 70% of the liquidity, now that makes sense. So liquidity providing on Uniswap works very well for the predator, for the large actor. You own the liquidity. You're getting all the transaction fees, the vast majority of them. And then, all right, then it pops and it gets some attention, and bam, now you just exit and you have capital gains to top it all off. So you're getting the liquidity in the meantime, and then you sell for a profit in a year or two. So liquidity providing, you really have to assess the position size as we've discussed. Does it even work? And the small actors, it doesn't. It is easier to make money with money. Without money, it's very difficult. It's very difficult to get that first $100,000 that Charlie Munger talks about. And that presents very different considerations for how to get into a routine, a strategy of better capital management. Does this say really 30% less volume week over week? All right. Look at that. Uniswap with $1 billion worth of transaction fees, 24 hours. It's just, this is why we've talked about the specific protocols we've talked about. This is why my portfolio is constructed the way it is. This is why we've cut interesting protocols loose in favor of other protocols. This is why I believe last stream we talked about the three significant sources of transaction activity on Ethereum mainnet, their size, their target audience, the moat that they have created for themselves. Curve, Uniswap, Balancer. Very different targets, very different actors that have interest in them, but that's mainnet. And then we put into context the scale of the L2s, which are marginal, all the liquidities on Ethereum mainnet. That's the bottom line. Tapsy, yo, yo, yo. Under Fighter, will the euro also deflate? It's all deflating. It's all of it. All the currency units, because it's all, the vast majority of currency units around the world is dollar credit. And that is significantly less than 2008. Will we get above 2008? Can we have transitory periods of total currency growth? Sure. That's our past cycles. Now, we don't really have charts and data for for overall global currency. Eurodollar system is a very opaque market. Nobody has that data. But, you know, with the artificial interventions, that's like the lifeguard and the chlorine getting to the kid who shit in the pool. The artificial interventions suppress volatility, which, given enough time, allow capital to start to want to get back into the pool. Why? Because capital sitting doing nothing doesn't pay the bills and doesn't produce income. And the whole point of capital is to create enterprise and activity, provide a service, buy a good, to sell a good, to make a profit. So volatility tells people don't do a damn thing. But as the volatility is suppressed, we see exactly what happened. Over the last 2 weeks, we saw banks fail, systemic crises in the United States banking system, and the volatility was suppressed. Isn't that fascinating? When you put it into these terms, literally that's what they did. It was an act of suppressing volatility. Otherwise, there would have been actors that are like, what the fuck, this bank just went under. How much capital did I lose? Even if they didn't, if a company didn't lose any capital, the mere potential for them losing capital would have affected their behavior. Maybe they would have shut down an R&D department they were spinning up, or they wouldn't have done 20 new hires for their tech division because they're like, oh shit, what if? Where are we? Let's reassess the balance sheet on our overall health. So volatility causes inaction. Suppression of volatility, given enough time, allows activity to reemerge. I find this chart the most interesting, one of the most interesting from a quantitative perspective. Even just from a technical perspective, look at that candle on the 6-month chart. That's quite remarkable, and it's a starkly reminiscent of 1985. Now, you got to think in terms of geopolitics relative to international currency. Right now, the rest of the world wants a cheaper dollar, gives them more buying power in their respective currency, which is what the U.S. doesn't necessarily want, because, but as I said, that's geopolitical considerations. But looking at this chart, the dollar has been in bull market since July of 2008. There's a reason this chart is cyclical like this, because after a period of outperformance, in this instance, 13 years, give or take, of outperformance, other countries are probably starting to get pissed off, as you've seen in the news. You've seen talks and actions by other countries. Like, I don't want to play this game anymore. So, how does the U.S. reset, recalibrate that sentiment that is propagating through the system? All right, here's your strength of currency back. And all of a sudden, everyone will just forget about it. If the euro all of a sudden is back to 2 to 1, oh, they got a lot of capital. They could buy a lot of dollars. They could buy a lot of energy. They could spin up a lot of manufacturing. They could do whatever the hell they want to do. They have much more purchasing power of the euro versus the dollar. So that gives their central bank more power, so on and so forth. And this is why this is so cyclical for so many years. Let's put up some date ranges so you guys can have a little bit of perspective. 1985 to the bottom. Let's go here. 2,378 days. Sorry. 6.5 years from top to bottom. And then if we go here, 2002, the bottom, 2191 divided by 365. 6 years. Come on. So the point is, at some point, the U.S. will have to capitulate to geopolitical pressures, and this plays into the narrative of countries not saying they don't want to use the dollar, but it doesn't work like that. George Gammon put up a great chart, or retweeted a great chart, about total debt in the system. It's all dollars. It's everyone around the world that they've borrowed dollars from everyone. And if you borrow dollars from a bank, and it doesn't matter in what country, that frickin' bank wants to be paid in dollars. So this is the dollar demand. So with peak globalization behind us, we're not going to be opening new factories in China. Everything's spinning down. This is repatriation of supply chain. This is the narrative for the last 3 years. How do you export the dollars? It's not going to be with a negative trade balance, where you're importing more than you're exporting. So the net is an export of dollars. You're not going to be able to get the dollars internationally in a um, post outsourced world. So the peak globalization is long gone. There's no going back from that. So they're going to have to find the new way to export dollars. And right now we're in a period of transition period of complacency. I don't think the companies, the enterprise, and even the countries don't know what to do, how to play their hand. But from a technical perspective, man, that blow off top, that shooting star is quite stark. And that was last year. That was the middle of last year. So give it 2 years' time from is 2023, 2025. We'll see the dollar lower. And the second the dollar breaches below, like this 6-month TWAP, that's like the lifeguard really showing up with a huge amount of chlorine and cleaning out the shit in the pool. And that's when capital starts to reallocate. Will it be less capital than 2008? Almost guaranteed. But there's still a tremendous amount of capital in the system. And depending on what artificial acronyms U.S. regulators come up with, they're probably going to have to figure out a way to export a significant amount of dollars outside of the country to sustain debt servicing load. And, we're going to go back into a low interest rate cycle. Everyone around the world is going to be able to refinance all their garbage on the books for low or negligible interest rates, but they're still going to need dollars that the U.S. is absolutely required to export. Hope that helps. Dominic, hey, haven't made it live in a while, been out of work, but I'm still, because of work, been watching all the time. Yeah, stories have changed over the months and years at this point, but this is a good place. I think this is a very interesting situation for all markets structurally, technically, considering where we are with regard to the dollar relative to other countries. The odds are a move will have to be suppressed. It's artificial. There's not enough collateral in the system. That's just the bottom line. People that have the collateral are incentivized to literally just provide liquidity with it. That's why the move went up, as Ben pointed out earlier with a retweet. If they're providing liquidity, it gives the opportunity for volatility. At least that was what I took glimpsing over that data he retweeted. But there's not enough collateral in the system, which means there's not enough debt. And probably one of the biggest constraints there is political comprehension of the economic construct of the world. It's also the optics of the Fed, of national debt going from 31 trillion to 50 trillion is quite unpalatable. The general public still has that has an understanding of healthy spending and debt habits, but that's not the way it works with governments. It's a very different situation when the vast majority of debt around the world is dollar denominated, and the collateral is used as an actual economic tool. And there's not enough collateral in the system, and there's not enough currency units in the system. And that causes all sorts of distortions. Look, how do you increase the supply chain? You need to have a bank be able to lend you capital so you could spin up infrastructure. And if banks are failing in the U.S. and you can't borrow, and Credit Suisse just exploded and got bailed out, got sold. It's volatility suppression, by the way. Then you can't get a loan for $5 billion to spin up some international supply chain infrastructure. That takes 5 to 10 years to execute on, by the way. So how do you cure the supply chains without credit availability, with these interest rates? You're not going to be able to. The debt construct is too big for these interest rates. These interest rates need to come down. But they come down cyclically. They raise the rates because of the optics of consumer price inflation to account for the disruption in the supply chains. So they have to impoverish everyone, take away their dollars, make a dollar shortage for the individual, which has its own optics considerations from a political standpoint. But then they have to drop interest rates so they can encourage economic activity to allow the supply chains to even have a chance to rebuild. And as the supply chains rebuild, inventory increases. Why? Because people want to make a profit. They want to sell things, and that is what drives down prices to get the price stability. So the price, in many regards, I guess you could say the Fed needed to increase the interest rates like this, and then needs to drop them, and you get the double side of consumer price inflation coming down. Suppression of available currency units, and then the increase of supply chain activity after interest rates come down and credit becomes more available. And that increases supply, and that decreases supply and demand pressures, or stabilizes them. Loki, hey Noah, so grateful for your streams in these market conditions. Really helps to be brought back to the 6-month charts when compared to 80s. I mean, isn't that gives me all the comfort in the world to know where we are in cycles and to think in terms of what survives and to think in terms of our entire portfolio as a balance sheet. Is it healthy? Can we survive? Can you service your debts? Do you have a capacity to make income? That income's going to go up. That income's going to go down. If the income goes down 50%, are you still good? All right, then you're still good. If it comes down 50% and you have too much monthly obligations, it's not very comfortable. Get rid of the Corvette and get a $199 a month Toyota Corolla. Probably going to sleep better at night. Balance the balance sheet, and that's how we survive mentally these types of economic cycles. CryptoTube, Cheetao, check the latest proposal. I didn't look. I have a Cheetao position. I don't know how they're going to migrate or if they would even consider that, if it's contractually possible. But VE, like what Balancer did with 80/20 VE, voter escrow positions, is quite innovative, and that's why Balancer has carved out a meaningful place on mainnet at this point. But Balancer has extended to other chains as well. So the I we all know that I have an interest in what Balancer and Aura has created with their synergy. And the 80/20 VE positions is very interesting, particularly because you still have the VE, but you're not disrupting liquidity. In fact, it creates a protocol-owned liquidity of sorts, or at least a locked availability of liquidity. So it's basically an assurance of available liquidity in the market, while also allowing the VE to behave as expected. Lucian, good morning. 34 people in the stream, 16 likes. Thank you all. Let's look over a couple of things. Everything's getting the volatility hammer today. Aura down to 280. But we made a nice observation about stuff like Aura, stuff like Curve, and stuff like Lit. There's a very interesting horizontal dynamic to them. They tend to range quite cyclically. This is very new, so it's hard to see it here. Aura is a little bit older, and Curve is obviously much older, relatively. It's just a couple of years, so put that into a frickin' macro context, would you? But look at the horizontal price action, and then look at Aura. That's just straight horizontal. Obviously volatile from $4 to $1.50. But in crypto, that kind of volatility is not unreasonable. And if you just look at it visually, this is incredible horizontal price action in a range, very volatile priced range. And we obviously see that with stuff like Curve. Neglect the hyperinflationary launch of the protocol, but then you could see it's a very, very horizontal price action chart. And I find that to be a very interesting commonality, that this is the behavior of these particular protocols that do a very similar thing. They're designed to be a sold currency. They're designed to have a sterilization function, which is the voter escrow that recycles the currency back into the system, not allowing excess supply in the market, which will be continuously depreciative. That's what a hyperinflationary event is. Keep increasing supply, it's going to continue the depreciation. The only reason these protocols can even be horizontal at all is because the recycling is occurring. If it wasn't occurring, these protocols would be history. All of them. Balancer, Aura, Lit, the emissions, the currency creation, increase in circulating supply would have destroyed these currencies a long time ago. So the fact that we have this horizontal price action is depictive visually that the recycling regime is working. That's what's meaningful. I don't expect the asymmetric appreciation like we've seen with other assets in the space. Obviously, in cycles into the future, I expect a leg up, a new range where the market has to discover the new price. And mostly, I'd probably be looking to overall liquidity in the system changing. So I don't expect any changes anytime soon. Let's go to mainnet because that's what counts. It's volume. Let's go over to stables. Mainnet, all 132. Mainnet was 73.55 billion dollars, and there's big outflows, but there's also sporadic periods of inflows. $2 billion flowed in on March 12th. Pretty interesting. What is this candle? $2.58 billion worth of inflows. Quite fascinating. So this is the measure. Filter by attribute, USD flows, total market cap. So we have data back to 2021. Back in late 2019, there was basically nothing. There was maybe a couple $1,000,000, and now we're in billions of dollars. So this has all the earmarks, all the attributes of a market that has actually captured dollar liquidity. The liquidity at some point, it doesn't want to leave. It wants to stay here to engage in this kind of activity, to be allocated to these types of enterprises that have cash flow, just like a traditional value investor would look at with regard to balance sheet inspection. So what this chart right here shows that this market has garnered the attention of actors. And that's what's significant from a 5-year perspective, from a 10-year perspective. So now we look to the changes in global systemic liquidity conditions and the availability of currency units. And what happens is when currency units become increasingly available cyclically in the future, it's going to allocate to places that have shown resilience, places that have shown strength, longevity, functionality, maybe systemic significance and importance. And that is infrastructure. So what survives this crypto liquidity exodus is the infrastructure. And then subsequent cycles, 3, 5 years down the road, the new protocols, all the hysteria and frenzy we experienced in 2020, what does all the new shit build using? They build using the infrastructure. I very much look forward to the next cycles over the next 3, 6, 9, 12 years of perspective. So that's the perspective to have that gives me my peace of mind and understanding the conditions and where our current short human time frame conditions that we have to deal with on a daily basis, these conditions fit in to the overall trends and pressures in the market over much longer time frames. That's the deal. That's the bottom line. Do you like Aura Bal instead of Aura? Hard consideration. I did increase my VE Bal position, not Aura Bal. I prefer not to have liquid positions. I prefer to have ownership, a purchase. I cannot sell them if I wanted to, which is that is a big consideration in how much capital is deployed because I don't have access to that capital. It's a purchase, which basically means I need to make sure I have capital elsewhere to service my debt obligations and finance my consumer staple purchases, food at the damn supermarket, in other words. So these are the considerations. Or a bow, not interested. Not interested in the liquid assets. I have very few liquid assets. If I have a liquid asset in this market, I'm going to sell it. So the only thing that I could possibly have that I wouldn't sell is in a liquid asset. I've taken a couple of positions over the last months in the liquid assets. Folks on Discord know that I bumped the VE BAL position. Folks on Discord know about the VE lit position. Um, Folks on Discord know that tapioca is coming. That was a position taken in December. And these are all pretty much determined, predestined to be illiquid positions thought of as a purchase, a speculative purchase. And I have liquidity elsewhere. And that is the calculation that I make. Killis, good morning, a pleasure. 34 people, thank you very much for sticking around to the end. We'll wrap it up here. We have an interesting week ahead. I would love to get back to like Wednesday streams, like 3 days a week. Monday to Friday, that's too far. I hope my schedule changes a bit where I could do more content for you guys, not just shit posting on Twitter. But in the meantime, we'll see what plays out. We'll see how the market evolves, see how business evolves, employment and whatnot. And don't beat yourself up over the market. I remember years ago when I engaged with these markets, and I was just constantly trying to outperform, trying to own something that went up in price. But when you put it into the context of the biological systems, the predator and the prey and shit like that, you're like, no, this is not the time to be doing that. You can make some purchases, and nowadays, buy things that pay you. Buy things that are likely to survive. Buy things that are likely to be infrastructure. But you can't spend all your money, because if you're going to make a purchase that you cannot sell, you got to make sure you have money elsewhere. You got to make sure you have liquidity. You got to make sure you have currency units, dollars, available to you in a market that is short of dollars. Everyone is short of dollars in some way or another. Thank you all for joining Monday, March 27th at 12:34 p.m. Tell everyone to subscribe, and you know the deal. After party on Discord for the most rational community in the entire crypto space. Y'all have a good one now. Peace.